listeners to YouTube, X, and LinkedIn. We are live streaming. I'm Andrew Wilkinson, Director of Trading Education with Interactive Brokers, and joining me is Senior Economist Jose Torres. Good morning, Jose. How are you?
Good morning, Andrew. Great to be here. New intraday session. The government shutdown had a lot of the economic data releases. The dates were all over the place and they were getting delayed. So we figured with today's report, we'll go with consumer confidence, which is a private sector data print release from the Conference Board.
All right, let's dig into that one, and then I want to have a look at the prediction market for this. Let's start. It's the Consumer Conference Board number coming out. What's the headline? And then we'll go into the components. What's the headline expected to be?
Okay, first let me show you my screen, Andrew. This is the last print from January, and we got the weakest number in 12 years. Lower than even the pandemic numbers. So that's pretty significant from a household sentiment perspective. As far as what we're expecting for today's number, we're expecting a number slightly higher, up at 87. And the major components of the consumer confidence index are essentially how consumers feel about current conditions, the present situations index, and the expectations index. So how do they feel about the next year or so?
Right. Okay. And so you say we're looking for a slight rebound here. Lesser important is current conditions. We don't want to see people being more pessimistic about the future, but that is a factor. Now tonight we have the State of the Union address, and at the front and center right now is connected with what we're going to look at today here. So the economy ought to be on everybody's radar. What do you think President Trump is going to deliver about this?
Well, I think President Trump is he's been, having his issues with the institutions, specifically the Federal Reserve, and more recently, the Supreme Court. So I'm expecting the commander-in-chief to come out and essentially insult some of the justices from the Supreme Court and reflect frustration that his broad tariffs were deemed illegal. And now the administration is navigating separate avenues to maintain its restrictive trade policy. Also expecting him to talk about how since the beginning of his term in 2025, the markets have done well, unemployment is low, there's been progress on inflation, and of course the AI build out is continuing. So I'm expecting him to talk about those broad areas.
Right, but given the kind of mess in Washington, it doesn't really send a very coherent signal. There is what we're seeing, a lack of confidence. So you think that's going to be continued in today's data?
I think so. I drew this line here, Andrew, just to let everyone know, to show everyone the where we're expected to be at 87. So really a lot lower than we've been for most of the past 6 years. The 6-year chart going back to April 2020, folks. But honestly, Andrew, the talking point from the Trump administration has been that things are a lot better than the media and the data reflect. There's a lot of denial going on in terms of consumer confidence. That's been the strategy. There's no inflation has been a talking point. The economy is booming. So I'm expecting the administration to essentially talk about a terrific economy, even though the approval numbers are subdued, pretty weak. And going into the midterms, especially, our forecast trader here at Interactive Brokers is reflecting that the Democrats are going to win a majority in the House. The Senate, due to the composition and the fact that those are longer 6-year terms, there's an expectation that due to the seats that are up this time around, the Republicans will keep their majority in the Senate.
Now, for the audience, please do input any questions you might have for Jose. Reach out to us at Interactive Brokers on LinkedIn and X and YouTube, and the wonderful Andrea, who's producing today's show, will get them to us, and she'll certainly highlight them on the screen for us. Jose, let's have a look at the forecast contract. What does the forecast trader say about today's number?
Absolutely. So one thing with the forecast trader, Andrew, is that the consumer confidence number, you can only trade it about a week before the release, due to legal things that I'm not an expert about. So it's unlike a lot of our other indicators that you can trade right up until the release, like, for example, non-farm payrolls.
Are you saying that you can only start trading a week before, or the trading ceases
Trading ceases about a week prior for the consumer confidence index.
Got it. So where do we see the last print then a week ago on the on this series?
Yeah, pulling it up now. Yeah, so here for March, there's a expectation that we're going to see some improvement. There's a 69% chance for a number above 89, 56% chance for a number above 93. So, expectation that we will get a better number in March. But for February, that number is out. Let's see what it came in at. 91.2, better than the expected 87. Beating last month's January 84.5. So this is a positive surprise here on consumer confidence. Let's look at the market reaction.
Yeah, market's kind of funny. It was down to begin with, and then there was a strong rally running into this number, and now we're back down again on the S&P.
Yeah, that's absolutely the case, and we're pretty
and I'm not sure if the two are related, whether it's it's the 10 o'clock number that's driving it. I mean, consumer confidence comes out stronger. One would think that's a positive thing for the market.
Yeah, we peaked out on the S&P so far today at around 68.70 at 9:48. So it wasn't the 10 a.m. Number that, well, the 10 a.m. number did bring us a little lower, actually. We were at 68.47. Then once that number hit the wire, we're down at 68.36. But tough to say if it was the actual report itself. Yields, not really seeing much of a move there. Let's dive into the report, see what's going on under the hood.
Be interesting to see whether this was existing or future that's driven the overall index.
All right, well, the website is down, folks, so we're going to have to talk about something else. It's not my internet because we can see the market, but we'll go back to that in a second. Why don't we talk about the political races while we get into that, if that's okay, Andrew, or whatever topic you'd like to bring up.
Yes, certainly. So can you in a nutshell explain why the political races are so important for the next several months, Jose?
Absolutely. I mean, essentially, we have an 80% probability that the Democrats are going to win the majority control of the House. That's up from around 71% a few months ago. So they've been gaining ground. As far as why it's important, because if President Trump, he already maintains a slim majority. So when he's trying to get legislation passed, he essentially needs all the Republicans to side with him. So by having the Democrats control the House, now enacting legislation becomes increasingly problematic, because for the most part of the last 20 years or so, 15 to 20 years, it's been a really polarized Washington where the Republicans vote one way and the Democrats vote the other way. So if it's kind of tough to get things done if you have the Republicans controlling one chamber and the Democrats controlling another. Of course, right now at the moment, the Republicans control both chambers. So President Trump could get his way, generally speaking, although he does have to appeal to a lot of the moderate Democrats in both the House and the Senate when he wants to get things done.
Can't he just do what he wants and sign an executive order, though?
Not all the time, because sometimes, Andrew, the Supreme Court gets in the way, or other institutions that we have, and so you can't executive orders can't get you so far. You got to go to Congress sometimes. You gotta negotiate. You got to be a politician.
So, where are the real pain points here for the Republican Party as we're looking at the midterms?
Yeah, the pain points here are the fact that the way Wall Street and economists look at inflation, it's a totally different perspective from the way that consumers, households, and families look at inflation. In fact, the real people in society on Main Street, Andrew, they want prices to go down. All right, they 3% CPI down to 2.4% over 12 months. That's not good enough for them. They don't really feel a significant impact, right? But the discipline of economics has evolved in a way where we don't want prices to go down because of what happened during the Great Depression, because prices going down is bad for demand and it's bad for employment and for economic activity. In fact, if I told you, Andrew, that prices were going to drop across the economy next month, let's just say, for argument's sake, 10%, wouldn't you just save all your money right now, not spend a dime, and then wait until March hits to start spending? And those kinds of psychological impacts are the reason why monetary policy institutions maintain an inflation target. Developed nations around 2%, some others are up to 3%. And other emerging nations up to 4% and higher. But the reason why there's an expectation of a positive inflation rate is to accommodate population growth and gains in productivity, while also amplifying the money supply and not leading to a retrenchment in bills in circulation or credit availability, because that would almost certainly spark a recession. So that's really the bifurcation there, Andrew. Folks want prices to go down 20%. The Fed is fine if CPI goes from 3% down to 2%. So it's a question of, final point here, just to really drive it home, folks. It's a question of a deceleration in price pressures that the economist community would like to see versus an outright decline in cost forces. And that's what families and households want to see.
I think families and households are kind of accustomed to seeing their purchasing power eroded with sharply higher food costs, particularly in supermarkets and so on. So if people vote with their wallets coming into November, which constituencies are most at risk for the Republican Party?
Well, I think if I can just finish up the last question before we go to this one, Andrew. So prices are definitely a thing. Also, the manufacturing recovery rebound that we've been expecting from an employment perspective hasn't manifested. So a lot of those Rust Belt states, they voted wanting to see more high income manufacturing opportunities for those areas. There's chatter that those positions will open up in the next year or 2 or 3 years as investment continues and persists. However, and investment has been very strong, but 30,000 manufacturing jobs lost in the last 12 months, that's the hard data. And then also, I think the housing situation is a big deal as well, Andrew. Of course, you remember President George W. Bush, 43, the son, he did his policy was.
Come back, Jose. There you are.
I'm back. I'm back. The American dream, and how home purchasing is important for building equity and for household formation and all that. So that's another thing that's going to be difficult for the Republicans, because despite interest rates coming down, mortgage rates north of 6, still challenging for prospective buyers. When you combine that with price growth that's so positive, albeit it's decelerating sharply. And then the fourth thing, Andrew, I think that's really, really going to hurt the Republicans is the whole immigration situation. Everyone knew, the Latin American community also knew, that President Trump is an immigration hawk. He wants closed borders. But what we're seeing around the nation with the apprehensions and the public discontent with ICE and Homeland Security, that's also expected to weigh on the Republican parties here into the midterms. As far as which groups are going to, getting to the question finally, Andrew, my apologies.
Okay.
Getting back to the question, I think the Latin American folks are going to either not show up or increasingly vote for the Democrats this time around. I think that the low income and middle income folks that had a lot of hope about a booming economy for them, they're going to either not show up or vote for the Democrats. And I think, collectively, those two groups, that would be enough to deliver to essentially deliver the House majority to the Democrats.
Which races are we going to be concentrating on to watch?
Yeah, we're going to be focusing on a lot of the House races in New York, in Pennsylvania, in a lot of the swing states and blue states. And in the blue states, you have a lot of those districts that are very close between red and blue. We'll be watching races in Florida, California, Texas, etc.
That'll be very interesting to watch. And I think something we learned in the last election, where Trump won in 2024, and even in the mayoral race, was the weight of money behind the eventual winners. So I think that the polling market showed a greater likelihood that Kamala Harris would win the presidency, whereas the betting market was showing that Trump would win. And likewise, you might want to comment on Madami's victory in New York.
Yes, absolutely. So really, the driving force of Interactive Brokers as a firm has been free markets and allowing investors from all around the world to participate in financial markets by taking on positions that they believe are the winners. And this extends, of course, to stocks, options, bonds, futures, now forecast contracts. And forecast contracts are a way to essentially extend the offerings, our more traditional offerings, which started in 1977, and extending those offerings out to the political landscape, where polling sometimes could be a little not as reflective of the actual population due to smaller sample sizes, due to a lot of times, Andrew, folks are ashamed to say, depending where in the country they are, what neighborhood they're in. Sometimes folks are ashamed to say that they're going to vote for the Democrats. Other times they're ashamed to say that they're going to vote for the Republicans. So with the prediction markets, with forecast contracts here at Interactive Brokers, essentially your identity is unknown. There's no survey respondent. There's nobody collecting your information or asking you whether you think it's the Republicans or the Democrats. And essentially, because it's a free market, it did a lot better than the polls in predicting that President Trump was going to win back in 2024 against Vice President Harris. And then also in the New York City mayoral election with Mamdani, when folks thought that, Cuomo is doing better now. He's gaining rapport with the Republicans and with moderate Democrats. And it looks like Cuomo is going to have a chance. Our markets really pointed to Mamdani having a heavy lead the entire time. And I think that's really where we're going, Andrew. We're moving into a new world where prediction markets and the free markets are essentially going to point and signal to where the higher likelihood is. In other markets, we've seen it too. Sometimes we have these recession calls on Wall Street, but the dollars keep going into the S&P, and it just effectively reflects that, okay, even though a lot of the experts, a lot of the economists on the street that are very intelligent, very smart, and very informed think that we're going to go into a downturn, clearly the investor community thinks that corporate earnings are going to continue expanding, and that's why they keep buying the S&P. So very similar situation. Folks in the polling community think it's more of a 50-50, but those people, political analysts at home, enthusiasts, they have increasingly a better grip on the odds than the actual polls. And I think that's really where we're moving to, where prediction markets are going to be where you look at to see where the chances are, where the odds are, with an increasing confidence that those numbers are more reflective of reality. There's also another segment of the population, Andrew, that talks about conspiracies and how the polls sometimes are designed to favor one side or the other. And speaking of confidence, the consumer confidence website is up and running. If we want to go there, not necessarily now, but could be later.
Yeah, we can certainly go back into that. I'm looking at the headline now. Consumer confidence index increased by 2.2 points in February to 91.2, from an upwardly revised 89 in January. The present situation, a separate index about current business and labor conditions, decreased by 1.8 points to 120 in February. And the expectations index rose by 4.8 points to 72. And this is for data through February the 27th. Anything in there that piques your interest? I think I kind of wouldn't have expected anything less, really. I think the present situation index, Jose, is where I'd expect to see this weakness, where people are kind of more confused. So, mind you, if this is going to go through 17th, this is before Friday's meltdown with the Supreme Court, isn't it?
Yeah, and just to dive deeper into the present situations, consumers' views of business conditions deteriorated. 19.7% of consumers said business conditions were good, a small uptick from 19.6%, but 19% said conditions were bad, up from 17.3%. Labor market conditions did improve slightly. 28% said jobs were plentiful, up from 25.8%. 20.6%, however, did say that jobs were hard to get, up from 19%. And just looking at job data real quick, just shifting gears quickly to today's ADP weekly number, we saw a strengthening here up to 12,750. This is a 4-week moving average of net new employees. So this has been strengthening from January 10th number of 4,250 up to 12,750. So that's been a very positive indicator, by the way, Andrew, for economic indicator fanatics and enthusiasts. These numbers now come out every Tuesdays, except for the week in which the ADP monthly jobs report is released. So this and unemployment claims are really giving us a good solid gauge, hard data here, folks, almost every week on what's going on in hiring and in unemployment. And hiring so far this year has been, pretty decent, turning back to consumer confidence now.
If we had 4 of those 12,500 weekly, we'd be looking at a 50,000 payroll gain on a monthly basis. Yeah.
Yes, which is not spectacular, but of course, without the immigrants, with the AI taking up a lot of entry-level roles from the supply side, the immigrants, rather the AI side from the demand side, the immigrants from the labor supply side, and then also from the demand side, rates that are just too high for real estate and construction, too high for manufacturing, and way too high for small business. Because when you look at the SBA loan, the spreads on that versus The 10-year are wide. So when you have rates that are 8%, 9%, and 10%, that's really burdensome for small business.
All right. And a quick check of the market seems that we're back a little bit higher. S&Ps are up about 13, and the Qs are up about 0.4%, and small caps up about 3/4 of a point. What are your thoughts on the stock market now? I mean, 7,000 continues to be like a tough line of resistance for investors to get above and stay above, Jose.
Yeah, absolutely. We're seeing where essentially, we have NVIDIA earnings coming up. So that's huge. Is the last of the Magnificent Seven. There's been concerns that the AI enthusiasm has been far too extended. But in the past 3 years, when NVIDIA has come out and CEO Jensen Huang, he does have a tendency to know how to calm Wall Street's fears, reduce the anxiety amongst the investor community by repeating that the demand for the company's chips and the modern technologies prospects going forward are incredibly buoyant. So we'll see what happens. As far, like you said, small caps leading. We're having a little bit of a cyclical tilt here, consumer discretionary, followed by technology, industrials, materials, consumer staples, real estate, and communication services all up. Energy, financials, healthcare, and utilities are down on the session. Yeah, it's with the thing with the AI trade. If the AI trade fizzles out, even though we have a robust economy and we are looking forward to several rate cuts and buoyant conditions following the Big Beautiful Bill's passage last year, which is expected to deliver heavier taxation refunds to Americans, as well as offer incentives for capital expenditures. And that's going to bolster activity this year, in my opinion. But the S&P 500 index is not dominated by the cyclically oriented areas. It's dominated by the Magnificent Seven. So can the cyclically oriented areas offset, counter potential weakness in the Mag 7? I don't think so, because these companies, they don't have these spectacular growth narratives of tripling or quadrupling revenue and earnings in 3, 4, 5 years. So because of those natural limitations, and they're more involved in old school businesses, they have a cap on the valuation multiple. So that's the negative side. But the positive side, folks, is that we have gone nowhere in roughly 3 months. So as you can see here, folks, we're at 68.46, February 24th. We were here October 27th as well. So we've gone nowhere in November, December, January, and February. What does that mean? Throughout this time period, the economy has grown and earnings have expanded, which means that valuations are cheaper now. So that's a positive aspect for more medium-term, longer-term investors that want to get in. That's a reason to do it, is that valuations are cheaper. If you're still worried, you can watch one of hundreds of Andrew Wilkinson's videos on Interactive Brokers on how to sell puts, and you can get assigned at a lower price if you don't want to buy at the spot price.
Oh, I want to just turn back to the data. The next big release to me will be next week. It's March, so in about 12 days' time, we're going to have the new non-farm payroll report. What is that looking like? You mentioned that you're constructive on stocks. I'm wondering what the year-end predictions are for the S&P 500, for example, and I'm also interested to know what's the most the contract of most interest to you. It could be a fun one, but I'm interested to know what you're watching, or where investors' interest is at this point. Let's start with the payrolls.
Yeah, let's start with the payrolls.
And don't forget, for the audience, please direct any questions to us on X or live streaming at Interactive Brokers, and also on LinkedIn. Direct any questions you have for Jose through those channels. Go ahead, Jose.
Getting with you in 1 second.
Just as a reminder, the number that's kind of bothering me is in when we had the last jobs report, there was a huge downward revision over the prior year, so that the number of jobs created for the entirety of 2025 was just 181,000, and that's the kind of number we became accustomed to seeing on a reasonable month. So something's kind of not right with the labor market in my eyes.
Yeah, so here's our 2027 contracts. And yeah, I mean, there's people that feel that way. Andrew, you see the 18,000 is 44.54. So there's actually a greater chance of.
Can you pop that out, Jose? It's a little small for me.
We're navigating a layout change here in a ForecastTrader. Let's see. Let me just have it take up the.
There we go. There we go. That's nice. Okay, so for January the 8th.
So there's a higher chance here of a negative number than a positive number. See, the north, the yes on 82,000 or the north is 52%, and the south is 46%. So a higher chance of a lower number than a negative number than a positive number. Higher chance of job losses and job gains in January 8th, 2027. That would be the December non-farm payrolls report.
Gotcha. And what are you looking at in terms of what are you seeing like peculiar interest in, or a contract that's kind of a little bit out there?
Yeah, so I think what I've been looking at recently, Andrew, that's really popular is the weather contracts, and we have commentary by our climate expert Patrick Brown. He's our head of climate analytics, and he essentially will go through different analyses on what's going on with climate. But this has been our number one contract, folks. So these are zero dated forecast contracts that expire the same day. So for example,
so today's temperature or high temperature, isn't it, in New York City or Chicago, for example, looks like somewhere around 38, 39 degrees. So it's going to be above 38 degrees with a slim chance it's going to be above, a slimmer chance it's going to be above 40. So somewhere between 38 and 40.
Yeah, and I mean, here there's a lot of the folks on 38 feel pretty sure that in Chicago it'll be above 38, but a short strangle kind of trade one could do is buying 37.90% and then selling the 41.80% or the 42.90%. Those are some things you can do, or buy the 75 here and sell the 80 here, or whatever kind of combination of those yes/no combinations. They could be a way to hedge one side and also magnify returns without necessarily needing things to go precisely your way.
So just give us a little flavor on that one, Jose. You said the yes above 37 and the no above 42. That both cost you 90 cents, and both can't be right? So what happens in that situation?
So you'd pay a total of $1.80, and a number in between would yield you $2 back. So that'd be essentially
27.
North of a 10% return, 11 or 12% return. Of course, I'm not a weather expert, neither is Andrew, or maybe you are, Andrew. Maybe you've been going to climate classes and you haven't told me. But if you're kind of all right between 38 and 39, you can kind of take a trade outside here and outside here, and that could work. And of course, you could even go narrower, 75 and 77. That'll add up to $1.52. And if you get in between those two, that would yield $2. So that'd be a pretty good return. $1.52 would turn to $2. That would be a return in excess of 30%. So those are some things that folks could do. And very liquid contracts. These contracts are being traded constantly. A lot of interest.
I'm just quickly trying to get to my weather app, and I mean, what is the inside story here? If I wanted to know what the weather was in Chicago, and I'm living in London, for example, here we go, Chicago.
While you do that, let's go to Steve Sosnick real quick. For those that don't know about ForecastTrader, here's our chief strategist, Steve Sosnick.
Hi, I'm Steve Sosnick, chief strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy a yes or no contract on ForecastTrader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
It seems you can't read a newspaper without finding an article about these new forecast event contracts somewhere. They're becoming extremely popular, Jose. Just checking my weather app there. The high for Chicago today is supposed to come at 4 p.m. at 37 degrees. And you can see that turning point there, Jose, at 37. So above 37 is 90%. So buying a no contract at 37, and interesting.
And now we're going to look at the S&P. I think you wanted to see the S&P out to year end.
Yeah, and we might be looking at the March 2027 contract. And then February.
Wow, so 65% above 65.50. That's pretty. If you're a bullish and you think we're going to have an up year, that's a pretty good contract at 65%. That returns $1. That's a good proposition in my opinion. If you think that if you're bullish, that's roughly a 40% return. 65 cents turns to $1 plus interest. Interest-like incentive coupons that pay an interest rate that shifts in proportion to the Fed funds rate. So when the Fed cuts, those cash flows as a percentage are reduced, and when the Fed hikes, the opposite occurs, where those incomes are as a percentage are higher.
And conversely, I mean, what stands out to me there also, Jose, is like above 7,600. So if people are kind of more cautious this year, then there's no chance it's going above 7,600. Yet I can buy a no contract for, is that 59 cents there?
Yes, that is 59. Yes.
Yeah. So it would seem if the caution prevails and the market either doesn't go up from here or even declines somewhat. I know Steve Sosnick has been saying that we'll probably close at around 6,500, but I'd have to kind of update myself with that forecast. The now above 59% looks quite interesting, and certainly above 8,000. There's 23 cents juice there if that's the case, right?
Yeah, I mean, which is quite interesting. I mean, this contract here, this 7,600. That's that 59 cents turning into a dollar, folks. That is a 70% return approximately. So that's quite significant. And then in the 8,000 contract that you mentioned, this 77, that turns into a dollar. That's a 30% return approximately. So these, some pretty good options here, possibilities for folks that are bullish, but also folks that are bearish.
I love the fact that you can consider both sides of the market, and as the chairman at Interactive Brokers says, if you understand the probabilities, you can do something with the possibilities.
Absolutely.
Right,
and you know what? And then that's part of the reason why Interactive Brokers customers outperformed the S&P last year. Especially the hedge funds did a terrific north of 30% return. Individuals did better than the S&P, so did financial advisors. So really a great testament, strong testament to the power of our tools and the offering that we have. Favorable financing when you're borrowing and when you have idle cash, strong securities lending, terrific execution, over 40 years of perfecting the technology. Also have global access from a single unified platform. And those are some of the reasons why our customers just did terrific last year in the markets.
Brilliant. All right. Let's just see. I just wanted to run over the markets. And yeah, markets have, and I don't know that this is much to do with consumer confidence today, Jose, but we're now up about 0.5% on the S&Ps and 0.75% on the Dow Industrials, which is the most narrow version, and almost 1% on the technology index. So a little bit of a rebound. I think we probably chewing half of yesterday's losses at that point. So it's certainly a better day, maybe driven by corporate news instead. Last word to you, Jose.
Yeah, I think so. And one thing that I use that when I used to be bearish in markets, one thing I used to say is that when you have a big report, the market has a way of making you sweat it out as a bear. So why would the market, and you can provide some insight here, Andrew, you have a lot more trading and financial industry experience than I do, but why would volatility spark before the NVIDIA report, right? The bears have to sweat it out. You can't have vol spike before the report, generally speaking. So let's rally into the report. Everyone can essentially decide whether they want to be on the long side or the short side, and then we'll have a move higher or lower, or no move at all. But being a bear and a value investor for a long time, it just always seemed like you had to wait until the non-farm payrolls report, the CPI, the NVIDIA print. You had to wait for a specific catalyst before you'd have volatility spark. So today's recovery made a lot of sense to me.
I think there is a school of thought, Jose, that says the markets are there to inflict the maximum amount of pain on investors. So that's to your point too.
Yeah, I think it's dirtier language too, but we're not going to say that here on this program. We're going to keep it nice and clean.
Brilliant. Great. Thank you very much, Jose, for walking us through the Conference Board's Consumer Confidence Report today, even though their website failed at the last minute there for them. But we got through it, and a great discussion on what's happening with money and markets today. So thank you very much for that.
Thank you, Andrew. Thanks, Andrea, for being here, and thanks everyone. And come back next month. We'll have we haven't built our schedule yet, but most likely we'll have Jobs Friday, Consumer Price Index, and then we'll choose another release for this monthly Spanish program for March. Thank you all. Subscribe to us, YouTube, LinkedIn, Twitter X, Instagram, Facebook. Connect with us everywhere. Reach out to us with questions. And thank you very much for joining us. Thank you, Andrew, for hosting as always.
Thanks, Jose, and thanks to the audience. Bye.